Cool. So, um, we're going to do a little session today that's going to go over a few tips for the use of the whispers indicator. Um, so that everyone can kind of figure out how I personally use it. The whispers indicator has four strategies inside of it, and each strategy is supposed to work with your trading style. You need to find which strategy adapts better to your trading style, and also what strategy works better with the stock that you're trading, and which stock works better with the time frame that you're trading on that stock. So there's no strategy that works across the board uh, for every um, for every stock or every time frame. It doesn't matter if it's our strategy or anyone else's. There's no strategy. There's no one strategy that works well across the board for all, stocks, forex, crypto. It doesn't really matter what you're trading. There needs to be certain variations in the indicator and in the strategy that you're using, um, that will allow you to get better returns and to get better entries on whatever it is you're trading. Um, so I want to go over those strategies today, and we recently added a a fourth strategy, which is the ultimate indicator. It will give you very reliable entries and exits with a defined, stop loss for your entries, and I want to go over a few examples on that one. The other strategies are more trend following strategies where you can use them as a guide so that you know in what direction you should be trading. So let's start with something very simple here. Um, First thing is we need to understand what a trend is. Okay, I'm going to use multiple examples here until we get. Hello, is everyone there?
Yeah, I think you went silent for about 10 seconds for me.
Um, okay. Well, sorry about that. A little glitch here. Not sure what happened. My Zoom said that I had logged out. You guys can still hear me all right, right?
For me, you're fading in and out. I'm not sure if it's the same for everyone there.
Okay,
I can hear you fine. I lost you a second ago, but I can hear you fine for the
okay.
majority of the time.
And that might just be just temporary, internet glitches for each and individual person. We'll do our best. Okay, so sorry for that interruption. So the first thing is we need to define what trend we're trading. Um, so for that, I'm going to use just Bitcoin, just because it's something that I know is trending. Um, so everyone can see here that Bitcoin is here in an uptrend, right? So what this means is that if you want to trade uh, Bitcoin or something that's in an uptrend, you need to you should be, I guess, to trade with the trend, you should be, trading things in an upward sense. So meaning going long or versus going short. Now, this is not to say that you can't trade it, to the short side, right, and still make money. You can. However, you need to understand that you're trading against the main trend. So if the main trend is up, you should be taking long positions because they will work, much better than taking, short positions. It's kind of like when you swim against the trend, right? So if the trend is up, we want to be taking, long positions instead of short positions. And if you do take a short position, you want to, you know, make sure that you manage that position accordingly because you're trading against, the main flow of things. So um, you have the whispers indicator. Another thing that you can use for another thing that you can use for finding the trend. Let's say you're not good at reading candles. Another thing that you can do is add some moving averages, right? So a lot of people for the a lot of people for the free version of um, of TradingView, they can only add, three uh, three indicators to their chart. So I'm going to try to find some indicator here. This is a good suggestion, right? So EMA 2050. All right, we're going to add this one to the chart, right? So here what we're doing is we have the 20 EMA, the 50 EMA, the 100 EMA, and the 200 EMA all in one indicator. So you don't need to uh, add three different EMAs onto your chart, right? You can just go here and edit this. Let's say we don't want the, say 2050 100. This would be the 100. Okay, there. We took out the 100, 50, 200. Yeah. So we took out the 100-day moving average on on the indicator, but you're free to do however you like. Let's just adjust this a little bit more. Okay, so we can see this a little better here in my old age. Cool, perfect. So we have the 20-day, the 50-day, and the 200-day moving average. Um, what you see here, and let's understand what a moving average is first. So let's say this here is the a moving average, right? So a moving average is the best way to explain it is let's say you have, 10 sticks or 10 toothpicks and you're just going to randomly break them, right? You're in different places. Um, and then you put them all side by side. Some of them are going to be, longer than others, which means that, but you're going to have an average, right? You're going to have an average size to the toothpick. And that's kind of the way that it works with moving averages and stocks. There's no rules. A moving average is just a moving average of price over a certain amount of time, and you want to consider that as you don't want to consider it as a hard set rule. Okay, price cannot break through it. Price needs to respect this moving average to the utmost extent. No, I mean price can go up or down above a moving average and still be holding that moving average. That's why, when you break 10 toothpicks, some of them are larger, some of them are smaller, but you have an average, right? So let me see if I can find the tool here. Perfect. Okay. So price can go up, down, down, up, down, up, down, down, down. Okay. So this here is the moving average. And, this is price. Price can go up and down, up and down, up and down, and, still be holding this moving average here. It's still in this moving average. It's still kind of deciding what's going. It's not because price does not have to do this, you know, for us to think that it's holding the moving average. Okay? Price does not have to do this. It can be doing this and still be holding the moving average. That's why here, in this case here, we broke down, we're going up, we're broken down, but it's still holding this moving average. Just because it broke down, doesn't mean that it's not holding the price. This isn't an exact science, right? Um, so we have that understood. That's why we have this little wick here, right? We have this little thing here that didn't exactly respect the moving average. Here, it's kind of stuck between two moving averages. Here, it's up and down, but it's holding the 20 here. And now here, we're also holding, we're attempting to hold the 20 here on Bitcoin. Okay. Now that we understand, the role of a moving average in in you know in price movement, um, I'm going to explain why we use the 20, the 50, and the 100 day. And this is just, it's industry standard, right? So everyone in the world, ever since the beginning of time, has just kind of decided that the 20 day, the 50 day, and the 200 day are the most common moving averages to use. Now, I use the EMA here. It doesn't really matter if you use the moving average or the exponential moving average. It's all the same. Um, it's you're going to have slight differences, obviously, but in its essence, it's the same thing. So a 20-day moving average is what we consider a, let's say, a scalping moving average, right? It's a very short term moving average. It calculates the average price of the last 20 candles. Okay. Um, so with this, we can say, oh, I want to scalp the market. Okay, great. You want to scalp the market? So you might want to use a 20-day moving average to determine, where you enter a trade. Um, the 50-day moving average is more for swing traders. Okay, so it's people that want to take the trade and they want to stay a little longer in the trade. They'd use the 50-day moving average. A long term trader, someone that's going to try to, stay in the trade um, for a longer period of time, let's say months, months to years, they would use the 200-day as a guide as to where to enter. So here's a good example for you. So let's say you were a long-term trader, you were trying to enter the trade around the 200-day, right? You would have entered the trade here, in this area here, and since September, you would not have had any other opportunity to enter around the 200-day. You would still have been in the trade, and you would probably be looking to exit, once this price breaks the 200 day. Now, excuse me, this is a longer term, moving average, right? So you see here, that was the only touch that we had to that moving average. Maybe you could have gotten in for your first try right here, also at the 200 day. So as you see here, you have maybe in the last year, two entries. I mean, you could have even tried here. You had two entries into Bitcoin when the moving averages were stacked. Now, what do I mean by moving averages stacked? It means that the 20 day, right, is above the 50 day, and both of those are above the 200 day. So when this is happening, when the 20 day is above the 50 and the 50 is above 200, it means that we're in a strong uptrend, right? So if we look back here, and see at what point in history, this scenario, happened, right? We can see the movements that originated, after this condition was validated. So here, we got this pop. Here it kind of went flat, and then here we eventually, moved up big, right? So what you want to see when trading, what you want to look for is for the moving, and this is just a basic, trend following strategy, but what you want to look for is this condition right here, right? You want to look for the 20 day, right, over the 50 day, and the 50 day over the 200 day, right? So from this moment on, from here, we know that we're in a strong uptrend, right? From this moment here. So once we know that, we're in a strong uptrend, it's our job to find our entry, right? And we could have done this here in multiple ways that we've talked about also in the past. We could have gotten in. We could have gotten in by finding the triangles. We kind of have a flat top here where it broke out there, and kind of started moving up. We could have used these triangles that we find here as price moves up. We talked about this on another trading session. Just kind of finding these patterns, and we could have entered the trade at any time, on any of these bullish continuation patterns that we've talked about, right? And because the moving averages are stacked in our favor, we're doing the trade in favor of the trend. And that's why this is working out so well, right? That's why if we, that's why if we buy these breakouts, you know, that's why they work out so well, because we're doing the trade in favor of the trend. Now, had you taken the short trade, so let's say you wanted to trade there, right? Or you took that short position, or you took that short position, or that short position, you can see that it would not have worked out so well. I mean, maybe you could have got some some little percentage out of it, but for the most part, the trade it's being done in the opposite direction it should have. So if you were trading in favor of the moving averages, you would have been, pretty profitable, not many headaches. If you had been trading short, then, you would have been like scalping the market, I guess, and it just wouldn't have worked out so well. When in turn, usually the short side is much, is much it's much easier to trade in my opinion because it's much faster. If you take a short position, it's usually pretty quick you know to drop. It drops a lot faster than it goes up. But because we have the moving averages stacked in our favor, um, price goes up, pretty decently, and we don't have many problems with stops or anything. We don't get stopped out or anything. Um, Here you can see here this is a bigger consolidation area. I guess here you could have started. We had some people in the market that started taking short positions. They would have worked out very well. Um, but still, they bounced here off the moving averages, and this would have been a short-term trade, and they eventually, lost. Here it seems like it's finding, a little bit more resistance, but again, here we are at the 20-day moving average, and price is trying to hold it, right? Price is trying to stay in this moving average and keep its uptrend momentum. Okay, so cool. Now that we've got the moving averages stacked, right? This is what we know we're looking for. Feel free to take a screenshot of this and and print this picture out and stick it to the wall right on top of your computer. And because from today on, you're going to say, okay, if I don't see this, then I'm not going to trade it. Okay, this is one strategy that we're talking about. It's not the only strategy, but it's important. It's one tool for you to trade. Um, so take a screenshot, print it out, and stick it up on a wall right in front of your computer. Where every time that you decide you're going to take a trade, you look at this picture and you see, okay, is what I'm going to trade, does it look like this? If it doesn't look like this, you're not going to trade it. Just keep it simple. Okay. Um, okay, so any questions up to here?
I use the 9 moving average. Is that better or the 20 is better?
Okay, sure. So let's do that. I'm using EMA. Let's exponential. So you use a 9. And
Correct.
I'm not a big fan of just telling people how to do things. I'd rather teach you to fish, so that you can think about it on your own, and try to figure out. So looking at the 9.
No, I get it. Yeah, yeah, I got the. I use the 9, the 50, the 100, and 200.
Okay, so the 9, the 50.
It's just big.
I'll take away
Mm-hmm.
the 20 here. So you use the 9, the 50, and the 200. That's what we got here, right?
And the 100. Yeah, just
You
like
use
you
the
got
100
here.
as well?
Yeah.
Okay, cool. So we have the 9, the 50, and the 9, the 50, the 100, and the 200. Okay. So what do you use the 9 for?
Just to see the flow of the market. Like,
Okay. So if I add here the 20, do you really see a difference?
it is a yellow, the 20 that's we just added.
Yeah.
No, it's the same basically.
basically it's the same. Okay, if you're using daily, the 9 is used, I guess, more for scalping, right? So if you're trying to scalp
Okay.
the market, so let's say that you were trading the daily chart, right? You're trying to trade the daily, and you have the 8 or the 9 moving average. You could use this instead of reducing the 5 minute chart, right? You could use that. You can just watch this on a daily, and you can just decide to buy every time it hits the 9. I know a lot of people use the sorry, this is probably not the best tool to do this. It's going to be real slow, but if you use the 9, I know a lot of people use the 9 and the 21. So the 9 and the 20 here crossed. Um, so there isn't really a difference. The thing is, the 9 is only calculating the average of the last 9 candles, right? Instead of the
Okay.
last 20. Um, so it's going to bounce up, on this in this area more times. Um, if you're trading on the daily, right? If I switch this to a 5 minute chart, right, you're going to see that it also, bounces off the 9, more times than it bounces off the 20. I would say
Correct.
if you're using a 9, then you're more looking to scalp the market or trade it on a very, very short term. On the 20, you see here, on the 20, it's going to bounce off, in a downtrend a lot less times, right? So while you have the 20 here and it only touched 2 times, right? On the 9, it's just always touching. And you can
All
use
right.
the 9. You can use whatever you want, really. It's just about whatever you're comfortable with.
I see the differences.
Yeah, so
You stay longer.
yeah, so I mean, if I wanted to trade the 9, I might get in, anywhere here, maybe, or say there. If I wanted to trade the 20, I might even get in the same spot, but here I'd probably. Ugh. Hello?
Hey, we're back. Think you dropped, right?
Alright, sorry about that. Something just crashed here on Zoom and
No problem.
to
It flashed up to say someone else was using the account, so
yeah, it was a second login.
oh,
Hold on just one moment here. Okay, sorry guys, I'm just admitting everyone in again.
Hey there. Somehow the meeting got kicked out.
Yeah, I'm just letting everyone back in. Well,
Okay.
if this didn't happen, it wouldn't be a regular Zoom session, right? So,
Yeah.
things have to happen. Sorry, it's only like 5 people that are still missing. But anyway, I'm sorry. Who was talking to me about the 9-day moving average?
Yeah, you said you were showing the entry points with the 20.
Yeah, I mean, it doesn't really matter. I mean, you just have to you just have to kind of use what's easier for you. Um, and you know, just kind of figure out what you want to use. I think that depending on what you use the 9-day for, I think it's going to give you more false signals. That's my opinion, but I'm not, I don't, I'm not a big scalper. But for example, if you're trying to see the trend, on the 9-day, you're going to see here in this area that it's kind of flattening out and it might take you out of the trade right here versus the 20-day, which is still kind of sloping down. And so it might keep
Yeah.
you in the trade, a lot longer. Um, Another difference is that the 9-day, for example, there's going to be a lot more crossovers, which if we're using that as a crossover uh, crossover strategy where you're trying to short the crossovers and go long, you're going to get a lot more crossovers. So you're going to be in and out a lot quicker of the trade. But I mean, if you want to use it, 100% go for it. I mean, it's your strategy, right? To play with as you see fit.
It's good to see that because every stock is different. So, like you're saying, if you want to scalp or swing it, both lines can give you whatever you want to look
Yeah,
at.
so I mean, like the 20-day, for example, the 20-day moving average is pretty standard, and I'll show you why. Um, I'm just gonna take out the 9 here. I don't need it for this case.
Yeah.
But so okay, just take my word for it. The 50-day is for swing trades, um, and the 200-day is a long-term, standard moving average. The 20-day, if I add on here the, Bollinger Bands, it uses the 20-day moving average, right? Um, there are a lot of, standard issue, market wise um, strategies that use the 20-day moving average as a guide. Um, so that's why I kind of prefer to use the 20 because there's a lot of strategies that use the 20 And so, if you use things that more people in the market use, then the trades tend to be, more successful because everyone is kind of watching that. It's just like this whole Wall Street bets thing, the social investing. You have millions of people looking at the same thing. So, if they get together and do the things, based on that same strategy, then things work out better. Not to say that people don't use the nine. I know a lot of people that use the nine and the 21 together, to for their strategy, but that's kind of individual, and just kind of use whatever you want to use. Okay, we don't need the Bollinger Bands. I don't use too much of this anyway. Um, okay, so any other questions before I continue? Is everyone back?
Just want to confirm you started the recording again, did you?
I did, yes.
Yeah, cool. Okay, cool.
I think so. I hope so. So, I don't know how the sound is gonna be, but I'll, like I said, do my best. Um, so now let's get, now that we understand a little bit more about moving averages and how they can help us in this strategy, right? I want to go over I want to start to go over how the indicator can help us. Right? Okay, so if we have the indicator, very aggressive. I don't recall how this how this is by default, but I think it's something like this. I want to say. Um, yep. So like this. Um, we don't. I mean, this indicator has suffered some changes in terms of aesthetics, uh, by the ever since it was created, and to kind of not make any drastic changes and have people use it. People that were using it since the beginning have any kind of difficulty. We kind of kept the same features, and but we made it personalized so that each person can adapt and can use it the way they best see fit. So this was initially, the idea was to use this with bars. Um, so we didn't have this. So the initial way to for this strategy, the way it began, was like this, right? So the way that you're supposed to use this strategy, I guess, is let's start talking about strategy one by one. Okay. What you're supposed to do is, let's pick a ticker, and let's say the aggressive, right? So we have this. This is a possibility, right? Then we have the very aggressive. This is a different possibility. And we have the conservative, which is a different possibility. Right? And we have the ultimate now, which is a whole other possibility. Okay. So you have four strategies that you can choose. And I've personally, more recently, I've unchecked this box and this box, but you're free to use it. If you like the lines, you'll see that a lot of times, uh, you know, price bounces at these lines right here and at these top lines. So this is one way that you can, use the lines, right? So price, you can get in here, you can get in here. Um, always, I always recommend using, the risk reward ratio, where you use a stop loss underneath the the signal candle, or underneath the candle right before it and then adjust as price goes. You see you have some nice, returns if you just manage your risk. So it's very important for you to do this. Oh, okay. Before we get into each individual strategy, I want to stress the importance of stop losses with the indicator. This indicator was designed to, and I'm going to put this out here, to make it easier for everyone. This is how I most recently use the indicator. I don't use the bars. I can if I want, but it feels like it's easier for everyone if they just use regular candles like they're used to. Okay, so let's use some regular candles here. So if you see here, price will usually bounce in these areas here in the middle between these lines, right? Or at the bottom line or top line. So you see here, it finds resistance at the top line. It finds support at the bottom line, right? Boom, boom. And this, you can use this strategy of the lines to, get in the trade when it touches these lines, right? And this is very similar to the 9-day moving average that we were talking about. It just touches these lines, and it doesn't matter what time frame you're using. It just kind of touches these lines, multiple times. So if price is here, right, you just saw this drop, right here. You're not going to want to chase this right here. You're not going to want to take this short position unless you're scalping it to get out right here. You're going to wait for price to come back to either this line or this line to take a short position. See what happens here? It found resistance and boom, it just dropped. So this here is your ideal entry point. Not here, right? Just like here, this is not your ideal entry point. It's here in this area. Okay. Same thing here. Boom. It dropped. You got FOMO'd here and you started selling, right? You got FOMO'd. So you got into a short position here. No, that's not what you're supposed to do. You're supposed to wait for a pullback, and maybe get in around here somewhere. Or, if you want to break this down into 5 minute, it can just, get in around there or something, whatever you want to do. And then it drops, and then it pulls back, and then it drops, and then it pulls back, and then it drops. And here, it came up here. You could have taken another short position here, but this here was kind of a clue that, it might be finding support in this area, or you might even have to look back even further to see, if there's support in this area. But here then it bounced, it didn't make a new low, and then it went up to make a new high, and the trend kind of reversed into a little, sideways range here. So this is how you would use the lines. Let's talk about stop losses, okay? Using these lines. Depending on where you want to kind of try to look for a low, okay? So for price to reverse, this absolutely needs to happen, right? This is guaranteed. This is what we call fractals in the market. So if this does not happen, price is not going to reverse, okay? So as you see here, a low, a lower low, higher low. This here is a fractal. You could have gotten in, here, right? And traded it up. Where would your stop loss have been? Down here. I always like to use this risk management strategy. So if this does not happen, right, then it's not making a new low, right? So you see here, low, lower low, lower low, lower low, lower low. Here, you have a fractal, but you're still in a downtrend. You can see by the colors of the lines, right? Then, low, lower low, lower low, higher low, still in a downtrend. You're still down below these lines. Then here you have like kind of low, lower low. You have another fractal here, which is going to give it, then it eventually, breaks up here, and you could have gotten in, here at this touch, for example, and traded this up. Let's say that you had gotten in here, right? You got in here at this point. Your stop loss would have been, down here, right? You would have been risking, 1.8%. This is all to say, it doesn't matter what strategy you're using, okay? For you to be right when you enter a stock, okay? Now, listen very carefully to these words. For you to be right for when you enter a stock, it's only going to make sense if you do not get stopped out, right? So if you got stopped out, that's because your entry was wrong. Okay, it was not the best entry. So you see here, you got stopped out here because you thought that, okay, this is the bottom. You're going to enter here, right? Because you think this is the bottom. Now, if price comes from here and breaks this, right, breaks your stop loss, you are wrong. This was not the bottom. Okay, does that make sense? You got in here because you thought this was the bottom. If price comes down and breaks that bottom, you were wrong and you need to be stopped out. And you need to go and find another entry. Just like here, I thought this was the bottom. Okay, I got in here, right? Because we were in an uptrend. So my stop loss is here, right? I didn't get stopped out on that one. I didn't get stopped out on this one. Price kept going. I thought that, okay, this was the bottom here, right? So I got in there. My stop loss is down here, right? I almost got stopped out, but I didn't. And price went my way, okay? So let's do the same thing here. Okay, so boom. I think this is the bottom, right? So I got in here, my stop loss down there, and it went up, in fact, but it then come down and I got stopped out, right? So this stop loss is here to protect me, okay? It's not here for me to lose money. It's not here for me to be scared that price is going to retrace, hit my stop, and then go up. This stop loss is to protect me from being wrong. It's here to protect me from myself, okay? Because I am flawed, I am a human, and I'm going to get things wrong. But when I do get things wrong, I want to be stopped out, quickly enough that my account isn't damaged. So that's what stop losses are for. Now let's go back here to the strategies, right? That's what pretty much everyone is interested in. So if you don't want to see the draw lines, you don't want to see the bar colors, just so you understand what they are, the bar colors are relative to the very aggressive, the aggressive indicator. So if you see here, the color changes. They match up with the aggressive indicator, right? So when the bars go white, the bars change color, and aggressive gives you a buy. So having the colors, the bar colors, and the aggressive doesn't make sense. So it's the same thing. You don't need that. You don't need to show bar colors, and my bar colors are. But and you don't. You can just have that, and if you want to use the aggressive indicator, right? Um, then what happens here is uh, when okay, this is the very aggressive. Take off conservative. Okay, let's dive into a situation here. Okay, we found out we don't need this. If you like the lines and you want to use the lines, great, go for it. Um, let's dive into ultimate here. So, trying to figure out the best way to explain this. So, let's go back to candles. Let's go to, let's say you're trading a random stock, right? So, first of all, we have our lines. Okay, this is the 30-minute, right? So, the I want to go over a specific trade here. So here we are on the daily chart of eyes. This was an alert for the penny stocks. Um, so here we are. This is the scenario that we talked about earlier, right? So we have the moving average. We have the 20, the 100, sorry, the 20, the 50, and the 200 day. They're stacked from here on the on the 5-minute chart, right? From this point is when all the moving averages are stacked. If you want to use this as a guide, if I go to the 1-minute chart, it will be different, right? So they're stacked from this moment on, a little further back. But you can see here all through this movement that the 20-day is above the 50-day, which is above the 200-day. So essentially, this is what you're looking for, right? And it doesn't matter what you're trading. I'm going to show you here multiple examples of this, right? So let's switch it over to the daily chart to make it easy. Okay, so AAL. See here, same situation. 20 over the 100 over the 10. So this is what you're trying to trade. This is when you want to get into a trade, when this situation is happening, right? When the 20 is over the 50 and is over. This is the first criteria that you need to look for when you're trying to trade a trend, right? So this here is the area reverse. So this is what you're trying to look for to trade the short side, right? This here, when the 20 crosses the 50, this is not the area that you want to trade. This is not the area here that you want to be in. You know, this here, this is not the area that you want to be in. You know, this here, this is not the area that, you know, you want to be in. You don't want to trade this area because there's a lot of chop. At least not with the indicator, not with this strategy, not with this tool. You want to trade this area, right? You want to trade this area. Because this area and this area are when you're, you know, this area, you want to trade, you want to attempt to trade this area. And, you know, this area. These are the areas you want to trade because this is the area that has just passed your first condition as a tradable area. Okay, your first condition as a tradable area is the 20 moving average over the 50 moving average over the 200 moving average. Okay, so, okay, now let's go to Apple. You know, do we want to trade Apple here? No. Right? From this moment, we don't want Apple. At least not on the daily, right? We're looking here on the daily chart. We want Apple in this whole area up here. This is one when we want to be trading Apple. Not here, right? Let's go back a little further. Here is where we want to trade Apple. Not here. Not here. Got it? So our first condition is the stacked moving averages. Let's go to AMC. Okay. AMC. This is where we want to trade AMC. And we're not yet discussing, how we're going to trade it. We're just trying to see if it's a tradable candidate. Okay. Do we want to trade, AMD in this area? No. Boeing? Yes. Right? BIG? Yes, ever since this area here. Let me try to. Okay. Box? Yes. So we're just going through the first conditions here. It's about to cross. If it's over, if the 50 has just crossed the 200, yes, it's a tradable candidate. Okay. This is the moment that we want to start to look at BP and, find our entry. Okay. We don't want to buy it right here. This is not the point where we want to buy it. This is the point when we want to start watching it for an entry. Okay. Bitcoin, everyone knows yes. Okay. Beyond Meat. Okay. You see the 20 crossing the 50. This is not where we want to trade it. Not for this strategy, at least. Right. We're just talking this strategy now. Okay. So we've gone through a few. Has everyone understood what the first condition to trade is?
Yes.
Okay, perfect. Any questions? Okay, good. So,
I have a question, Mattis. Sorry.
sure.
If you check this first condition on a daily chart, you will have to stick on a daily chart, right? You cannot check this on a daily chart and then go to trade in 1 hour chart, for example.
It depends. So you can. Uh, the daily chart is kind of the main trend. Um, so you can, let's go back to an example here. Apple. Well, not Apple. Okay, AMC. AMC. Okay, on the daily, it matched your conditions. If you come back down to the 1 hour, or let's do 15-minute, right? Does the 15-minute match your conditions?
No.
No. Okay, so it's not tradable yet, but it was tradable, from this moment here on, right? It was tradable from this moment on. Now and we're just looking for, the first tradable condition. Okay, keep that in mind.
Okay, got it.
Right. So what you're waiting for on the 15-minute chart is for the to become tradable. Okay, now you say, okay, 15-minute is not tradable. Okay, let's go to the 5-minute. Is the 5-minute tradable? No. Is the 30-minute tradable? No. Is the 1-minute tradable? Yes. Okay, boom. Well, it was. So from this moment on, it was tradable, right? But because we're looking on the 1-minute chart, you know, trade is over right here. So you would have had to have found your entry somewhere, here and, gotten out of the trade, whenever, pretty quickly. because you're on a 1 minute chart, right? So if you're trading on a 1 minute chart, you're going to be in and out of the trade much quicker than if you're trading on the daily chart. So if you like scalping, this is your strategy for scalping, right? What you can't do is say, okay, I found my entry here on the 1 minute chart. Okay, wow, this is going to work perfectly for the daily chart. That you can't do. That's something you can't do. But what you can do is go from the daily chart backwards to the 1 minute chart or to the 5 minute chart. But you can't go from the 5 minute to the sorry, to the
Daily.
higher
Yeah.
time frame. Because
Yeah.
let's say here, right? Is this tradable here on the 5 minute? Yes. Okay. It's tradable here. From this moment on, it's tradable to the downside, right? Up until here. So you find your entry here for whatever reason. Price drops, you're the king. Okay. Perfect. The problem is with this trade here, there's no problem with it, right? You made money from here to here. Oops. There's no problem with trading the counter trend. But if you go from here to here and then to the daily, you know, you're trading against the trend on the daily chart. And we all saw back on Bitcoin, right? We all saw back on Bitcoin what happens when you trade the counter trend against the daily chart. It's not going to work as well. But you could be lucky, right? You could be a lucky guy and say, okay, AMC is on an uptrend, but okay, I believe that we're at a top here and AMC is going to go back down, you know, to $2, and you decided to short it right here, even though it was on an uptrend, and oh wow, I'm the king. I just made, you know, 30%. Okay. You can make money trading the counter trend, but you need to understand what you're doing is trading a counter trend, right? So look here, I would have made 100% in 1, 2, 3, 4, 5 days, and you're here 1, 2, 3, 4, 5, 6, 7 days to make only 30.
Yeah, and much more risky because it was a counter trend. Yeah. Okay.
This is very important for you to understand is that you're making 100% in 5 days, and if you short it, you're only making 27% in 7. Um, this 27% is 27%, but it's a more risky trade because everything is opposite to what it should be. Same thing here. Okay, trend was valid, obviously, from this moment here on. Um, had you gotten in somewhere on this candle, you would have made 130% in 3 days versus, making 1, 2, 3, 4, 5, 6, 68% in 1, 2, 3, 4, 5, 6, 7 days. Right. So this trade is against the trend. You're always gonna make less on the short side. Okay, let's get that out of the way. Um, but it's just to show you that when you're trading in favor of the trend, um,
The odds of
things are
success
going to
are
work
higher.
out much better.
Okay,
So
thanks.
sure. So any questions about this moving average first criteria? Okay, good. So okay, let's look at eyes here. This was an alert for a penny stock on Friday, and this was alerted pre-market. we alerted eyes somewhere around here. In our penny stock channel. And then throughout the day, obviously, it was what it was. It went up a maximum of 367% to the top, and everyone was like, "Oh, okay, great." How could you have entered this with the moving averages? Okay, so with the moving averages now, it should be pretty clear why and how you would have entered this and how it would have gone through your first criteria of, okay, how do I get in? So from this moment on, it was tradable. So it was the first criteria was met. um, you have the indicator, right? So now you're like, okay, what strategy do I use? Okay, so let's go over the strategies one by one. First of all, in terms of strategies, this is the way it works. So now we decided on eyes. Now we decided we're going to trade eyes. Um, we need to figure out what strategy we're going to use. Are we going to use the very aggressive? Are we going to use, the aggressive? Are we going to use the conservative? Or are we going to use the ultimate? Are we going to use the ultimate? Truth is, when this is happening, when this first condition is met, then it really doesn't matter which one you use, because, and I'm going to zoom in here, and I'm going to show you that all of them work, right? So let's go over these few strategies on a smaller, time frame. So buy candle here, right? This is the, sorry, this is the very aggressive strategy, okay? Um, this doesn't matter. In terms of style, this is on an uptrend, right? So sell labels don't really matter to you. You're not trying to sell it, you're trying to buy it. So if you want, you can remove the sell labels. Okay. Now, oops. Now we're left with only, buy labels, which is what we're trying to do, is buy eyes. Okay, so same strategy applies as always. You want to use stop losses in case you're wrong. But this candle here, so this candle here is your entry candle. So your stop loss is right below the candle right before it. The Here you have another buy signal. Your stop loss is the candle right below, right before it. Here, same thing. Here, same thing. Boom, you were stopped out here, right? And correctly stopped out because you thought this was the bottom, and all of a sudden it wasn't. Okay, let's go again. Here, a buy here. This candle here did not make a new low, right? So it doesn't really do that condition we talked about, which is, the fractal, which we're not even going to get into. But just trust me, this is a fractal. It's called a fractal, and it's just a characteristic of, this 1, 2, 3 bottom. Okay, so you got this buy signal here. You might have not taken this signal because the one right before it had a higher low. So your stop loss would have technically been right below this candle, which, even this candle would have stopped you out. So you might have not taken that buy signal. Here you have this buy signal. Okay, this one matches that picture. So your stop loss would have been here, and your entry is always there, right? Your entry is always at the close of this candle. Okay, so same thing here, right? Your entry would have been here. Your stop loss would have been here. And you would have been stopped out here. And then, here, same scenario. Okay, stop loss here, entry there. Same thing here. Here you wouldn't have been stopped out. Then you get another buy signal here. This one wouldn't have worked out, but okay, depending on where you had your stop loss, of course, you wouldn't have been stopped out. And going forward, same situation. Buy here, stop loss here. Buy here, stop loss here. Eventually they would have worked out some, but then it ended up reversing. Okay, so that's that for the aggressive strategy. The very aggressive strategy. Now, the very aggressive strategy is going to take you in and out of trades, much, much faster. So, it's more for someone that likes to be in and out of trades, pretty quickly. So they could have very well taken these trades, gotten in here, and just kind of had an idea of where to sell. Going forward, then they could have, bought here. Could have decided, something like buy here, right? So you buy here. Here's your stop loss. Okay. So let's track the movement of price, right? So we just bought here. Okay. Get this out of the way. We just bought right there. Okay, price came down a little bit, then it broke up, right? And you're still in the trade. You're still in the trade right here. All of a sudden it reversed and you got a sell signal right there. And you're like, you know what? Okay, I'm only making, 6% or something like that. The moving averages still look good. Um, I'm barely making any money here. I'm gonna hold it till I get stopped out, or something like that. Okay, then you get another buy signal, and price rallies up to here. Now you're up 40%. Okay, then you get another sell signal here, and you're up 27%. Okay, so when we're in an uptrend, right? You don't want to give as much weight to the sell signals as to the buy signals, right? Because the sell signals are the counter trend. The main trend is up. So you decided not to take this sell signal, but here at this sell signal, you're like, you know what? I'm up, 27%. I'm going to get out at this sell signal. And then some people are like, oh shit, man, you know, I just got out here and then, damn, all of a sudden eyes took off and I lost 90%, right? That's what the indicator is for. So, yes, okay, you got out here because you were up 27%, okay? Automatically your trade is over, but your condition of the moving averages is still here, right? So you're still going to keep trading eyes, and boom, here's your next entry, right? So you got out here and you got back in right here. It doesn't matter that you got in at a higher price because your conditions are still met, right? You're not putting your stop loss down here. You're putting your stop loss under the candle right before your entry. So here you're risking 8%, you just made 27%, right? And we're going through the same, motion again, right? Up at the max, you were up 40%. Then we got down here, you're up 15%. Then you got another buy signal. Okay, now you're up. Now you're getting another sell signal. And you're watching this and you're getting multiple sell signals here. So sell, sell, sell. This buy signal just got stopped out. You're still in the trade from right here. You might decide to, get out of your trade somewhere around here. Not because of the sell signal, well, maybe because of the sell signal, but because you're starting to see multiple sell signals. Or, maybe you paid attention to our last, webinars and you started to see this build. You started to see this bull flag kind of build here, right? Then here it broke out, right? Here it broke out. You're still in the trade. Up here, you got another sell signal. It made a new high. Any of these buy signals, they're still kind of working. And you're writing this up, right? Okay, so here you're getting a few more sell signals. Here you got nervous and you sold, for whatever reason. You decided to sell and you made 40%. So for now, or you didn't and you kind of rode this up, to wherever because your conditions are still here. And then you ended up getting out of the trade there or here where the 20 crossed the 50 or, up here or whatever it is you got out. It doesn't matter. The point is your entry and your stop loss. That's what we're trying to define here at this point. Okay, so we have that. That's the very aggressive strategy, right? Now, you can mix strategies, okay? Don't do this. Don't use the strategy like this, okay? You are going to get multiple buy signals, but it's just going to confuse you, okay? So use one at a time. The only thing that I think you can use as a guide is, let's say that you want to use the aggressive strategy, right? You like the aggressive strategy. Okay. You still have your conditions here, right? You like the aggressive strategy, but you're like, oh, you know what? miss this entry. Okay, I didn't take that one. You're like, now I have to wait all the way up to here, another 50% move to get another one. I mean, sure, you can take this buy strategy here and write it up to there for another 100%. There's no problem with that. You can do that. Same, same risk reward strategy applies to this entry strategy. So buy, stop loss right there. Buy, stop loss right there. Keep going. Buy, stop loss right there. You would have eventually been stopped out. You could have gotten some here. Okay. So the same risk to reward ratio or the same stop losses apply. But you could have you can mix here a slower entry like the aggressive or the conservative to mix with a faster entry signal, right? So we don't need the sell labels. So we can go and have the aggressive strategy here. So let's just say, aggressive, we want it to be white, or not white, okay, gray, just so we can see them well. Okay. Then we want to add a faster entry strategy to get us in once these two strategies align. So once the aggressive and the very aggressive match, so we got this aggressive entry, which is a slower entry than the very aggressive. So we got this buy here. Now we can take this entry here, entry here, entry here, any of these entries, going forward. You can also, let's do this. Okay, so okay, that actually kind of works out. Hold on. Okay, so you get the green and red are the aggressive strategy. The blue is the very aggressive strategy. Okay, so very aggressive strategy here, right? Sorry, aggressive strategy here from this moment on. Okay, you could have chosen to enter this trade based on the very aggressive entry. This trade based on the very aggressive entry. This trade, right? But this, then you got the sell signal here. So, these two, 1, 2, you are not going to take them, right? Because you're on a sell signal from a longer time frame. Then you get the buy signal here, okay? And you start the process all over again. You take this one. You take these two, right? Then you're on a sell signal here. You're not going to take this one, right? Then you're on a buy signal here. You're waiting. You didn't get any. Now you're on a sell signal. So you're on a sell signal. You're not going to take these two. Then you're on a buy signal. Okay. Buy. You're going to take this one. Right. You're going to take these three. Same risk reward strategy, right? Then you're on a sell, buy, sell. Okay. You guys get the picture. Then day's over. Here the conditions from this moment on, conditions weren't there. You got these buy signals, but you forget them. Okay, you guys get the idea. Okay, if that's a strategy that you like and you looked at it and it works for you, great. Do it. If not, find something else. You can use the aggressive strategy, same method. Buy from here. You could have bought here, right? You got all these buy signals here. You buy here. Then, from this moment on, you're not trading the buy signals. You got the sell here, right? Then you got the buy signals here. You would have taken that one, and so forth throughout the day. So that's kind of how you mix the strategies, okay? So now let's go over ultimate strategy. Okay. So same method. You want the same method as any other one, right? So conditions are met, moving average conditions are met. Okay, so moving average conditions are met. You would have taken any of these two, right? Or, this one, if you even thought that, the alert that we gave was something valid, and so forth. The one of the important things about the one of the important things that's good to note about the about the ultimate strategy is that you need to note that when the buy signals happen closer to the 50-day, okay, which is a swing trade, moving average, like we talked about earlier, they tend to work a little bit better because the 20-day moving average is a short-term moving average, right? So if it's a short-term moving average and price typically goes up, then it pulls back to the moving average. It goes up, it pulls back to the moving average. It pulls up, back to the moving average, and it goes up. If you know for a fact that this is constantly happening and it doesn't matter what you trade, then you don't want to buy here, right? You don't want to buy at these points. You want to wait for price to come to the moving averages, be it the 20, be it the 50, or be it the 200. It doesn't matter. You just want to make sure that you're buying in this area instead of buying the tops. Okay. So same thing here, right? Here price was already kind of on a rip. It was already ripping here. You could have taken any of these and, followed the momentum with the same You know, same risk strategy, you know, and been scalping this. And this is kind of like why, you know, why I like to scale out. So, you know, if I had bought into, you know, any, and I think I talked about this on the live Telegram. Had I bought in here, you know, I would have taken profit, you know, here at 6. Um, and you're like, oh, sure, why 6? Because, so if I look on the daily chart, you know, 650 was kind of the midpoint of this daily resistance. So I would have taken profit here. Say I would have bought $500 or something here. I would have taken profit there. And then I would have looked back a little more and said, oh, wait, here's another resistance area. So I would have taken, you know, more profit here. And if we break this down back to the 1-minute chart, let me get this out of here. You know, we would have seen, you know, okay, I took profits, you know, here. I bought in here $500, right? Then I took profits there and I took profits there. And boom, my trade is over. I now have maybe some, and I'm just waiting for the market to stop me out, right? So I could have gotten out completely of the trade here, right? On that cross. I could have waited for it, and have put a stop loss down here below that 6, which I thought maybe would hold, or would have been below this low, and the market would have taken me out on its own. You know, not that the trade is over. I could have, you know, waited for this scenario again and tried to trade it again. Obviously, you know, towards the end of the day, the trades don't work out as well. That's just normal, as in the morning. Um, but that kind of, you know, goes over that trade. Um, let's talk about any other ticker. Let's see here. Um, 1 second. Let me look at some of our alerts. So cool. So let's talk about the SPY, SPY, our alert on Friday. Friday, we alerted to a SPY call. Not sure if you guys remember. And you're like, damn, you know, the market was tanking pretty much um, on the daily. So now we're on the 1 minute, and we're like, okay, why the hell would this guy, you know, get a call, right? So I think that we alerted this somewhere, you know, around here, right? From this moment on, and this is how you can use, you know, our strategies with the alerts. So this is how you can use the indicator with the alerts. So from this moment on, just some ideas, of course. You can have your own method, but the idea of this is tips and tricks. So at this moment here, you know, we had our first cross, which was the 20-day crossing over the 50. So it was a short-term bullish move. Okay, from this moment on, the 50 crossed over the 20 was over the 50, and the 50 crossed over the 200. So we alerted this somewhere in this middle, I think. And then from this moment on, you know, our conditions are met, and you can take the indicator and trade. Right? Stop loss there. You could have taken this first buy signal, From this moment on is when you're supposed to start paying attention and watching it. So here, stop loss, boom. Same thing here, stop loss. Same thing there, stop loss. And notice that, okay, this is the 1 minute chart, guys. So the 1 minute chart is very, there's a lot of false signals on the 1 minute chart, okay? But that's okay if you're, you know, just you need to learn to be okay with being stopped out. So look, you know, we're talking about a 0.12% stop out here on the SPX. You know, we're talking about a 0.12. You know, again, you know, we're talking about a 0.12. This is very, very tight. But it will serve to you as an entry point. So this first one would have worked out well. And you would have ridden that call, you know, all the way up. Even if you did, let's say, even if you did, you know, trade, you know, you missed this one, you decided to trade the second one, you could have gotten in the second one and just, you know, put a stop loss down here at the first one, right? That's when it was really good. That way you kind of give yourself a little bit more room. You're risking 0.30, right? The trend is still up, so you're in favor of the trend, okay? At least on the short term. The daily is looking a little worse. But, you know, you can see here that that 0.3 would have turned into a pretty good trade. So you can use prior signals. You can use prior signals as stop loss. So this here, you would have used as your stop loss, and you would have gotten in here. So you would have gotten in there, and you would have used this one as your stop loss. Okay. You could have also, if you favor it more, if you like it more, you could have, you know, used the same thing we just talked about and added the aggressive and the very aggressive, right? So from this moment here on, right, you're looking for buy points. We alerted you right here, right? This is where you got the alert. And, you know, you're going to take these buy points here on the very aggressive if you like the very aggressive more, right? You would have taken those. You would have taken this one, stop loss under there, you know, buy, stop loss under here, you know. And again, I'm going to say this again just so if you didn't understand it the first time. The signals closer to the 50-day are better than the ones on the 20-day because the 50-day is more swing trade. So you're swing trading instead of scalping. The 20-day above the 20-day are scalps, above the 50-day are swing trades, and above the 200-day are longer term trades. Okay? So you see here that, you know, if you had taken this 200-day buy signals here, right? Had you taken these 200-day buy signals and you decided that you're a longer term trader, you are not going to be taking any more trades until, you know, you get another buy signal on the 200-day. So, you know, you would have taken this trade and you would have not done anything else for the rest of the day. If you're more of a swing trader, okay, you would have had an opportunity here, you would have had an opportunity there, and you would have had an opportunity, you know, somewhere around here, I guess. Had you been a scalper, you would have had this opportunity, you would have had this opportunity, you would have had this opportunity, this opportunity, this opportunity. So scalping is going to give you a lot more opportunities, but they're going to be less reliable. Okay? They're going to be for quick scalps. had you taken the swing entries, they're going to be um, had you taken the swing entries, they're going to be more reliable, but they're going to last more time, and it's going to give you less entries. Had you using the 200 day, it's more reliable than the top two, but it's only going to give you one entry. So if you miss that one, you don't have any more. And the same goes for the other strategies, right? Very aggressive would have given you many entries, right? Aggressive would have given you one entry here. Conservative would have given you more entries. Ultimate gives you more entries as well. But you also have to take into consideration, you know, what kind of trader you are and where the signals are showing up in regards to the moving averages. Now, you don't need the moving averages to trade, right? You don't need moving averages. You can just, take our word for it and say, oh, okay, Whispers alerted SPY. Now I'm going to take the buy signals. Okay, we alerted it somewhere here. Boom, you bought it here. And we went up. Okay, now you're holding that for, I don't remember when it expired, but I think it was like the 24th or whatever. So that's kind of how you're going to use the strategies. Now, let's go back to eyes here, because here's another question that I get a lot is, okay, but what time frame should I look at, right? Truth is, it does not matter. If you're using this indicator, then okay, 1 minute is going to give you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. It's going to give you like 16 or 17 entries, right? Okay, let's do this accurately. So 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 entries. Okay, so from this morning on, this moment here on, you have now let's go check the entries. So 1, okay, here you would have been stopped out. Here 2, so 2,
No audio.
oh yeah, there's audio. I'm just counting silently.
Okay.
Okay, so 1 minute gives you 18 entries, 9 profitable, 9 that didn't have much of a gain. Okay, so let's just call them losses. Now let's go to the 5 minute. 1, 2, 3, 4, 5, 6. Minute. 6 entries. 1, 2, 3. You can still stick a 10-minute here if you want, but I'm just going through this as if you have the free version of TradingView. One entry. So this is what we've have for this case. Right? So does it matter what time frame we trade on? It does not matter what time frame we trade on, okay? You have to respect the rules of the strategy. It doesn't matter if you're on a 1 minute, on a 5 minute, on a 15 minute. When we alert to a stock or an option or whatever it is that we alert to, you need to find your entry on whatever time frame you're comfortable using. The 1 minute gives you 18 entries. 9 of them are profitable, 9 of them are losses, but you need to look at them and say, the ones that I lose, how much did I really lose, right? So actually, pretty much a lot. This was moving a lot, and it being a penny stock. So here you have an 11% stop loss, which is kind of a lot depending how much you're putting in there. Here, it's like a 3% stop loss. So you really need to pick your entries kind of depending on how much you're willing to risk with the stop loss. If you see an entry like this, like, okay, my stop loss is 12% away, maybe you don't want to take it, right? Or maybe you want to put a limit order like halfway down to reduce um and just wait for the next one, that has a tighter stop loss so that you don't risk as much. You have on the 1 minute essentially 18 of them to choose from, right? And with a 50-50 chance. Okay. If you go to the 5 minute, right? If you go to the 5 minute chart, okay, so let's say if you had gotten in at this point here and just ridden this up based on the moving averages still confirming your trade, you would have made a lot of money, right? If you're catching this halfway in, you're going to make less amount of money because you're getting in, later on the trade. If you're on the 5 minute chart, right, you're going to have less entries, more reliable. So 4 of them are profitable, 2 of them were losses. They're more reliable, but as you can see, you have to be into one of these moves, and you can't get here and say, "Oh man, this is gone up 100%, since it opened. Oh, it's not going to move anymore." No, that's not true. For things to move up, you know, 400%, first they need to move up 100%. Then they need to move up 200%, and then 300%, and then 400%. So you just need to trust the system. This indicator gives signals for a reason. Trust the stop loss reason, and it is what it is. So 1, 2, 3, you might have been stopped. Actually, you know what? 1, 2. Sorry, let me actually confirm this. So stop loss there, stop loss here, stop loss here, stop loss there, stop loss there. Okay, entry there. Okay, we can consider that a loss just for the hell of it. So this is actually wrong. It's 5 profitable and 1 loss. So if you were trading on the 5-minute chart, you would have had 5 entries throughout the day. You just have to watch it. Going on to the 15-minute chart, you know, you have this here, and you can um, you could have taken this entry. Obviously, the higher up you go, okay, the higher up you go, the bigger the candles are, and the further away your stop loss is going to be. Okay, so you need to take that into consideration. On the 15-minute, candles are pretty big. You have a 25% stop loss. Is that good? Is that bad? It's up to you. You could have, from this point here, okay, you got an entry on the 15-minute chart. Now you're comfortable trading it. Then you could have reduced to the 5-minute and, bought one of these entries, or even the 1-minute and gotten one of these entries. Now you're like, oh, okay, Paulo, shit. We can, how I work all day, right? How am I supposed to, I can't watch the market and wait for a signal. Cool. So you come here, you add an alert, okay? Condition, stockwhispers.net, ultimate buy, once per bar close or only once. An ultimate buy signal has been spotted. Create it, and boom. Sorry. Automatically, we have an alert that's been created on the 15-minute chart for eyes. So you got the alert from us pre-market, right? You put in an alert that on the 15-minute chart, you're going to get a notification every time this happens. You're going to get it on your phone, either via text or whatever method you're using, to that a buy signal has shown up on the 15-minute chart, and it might be time for you to take that entry. And all throughout the day you've been working. If you're home, you know if you're home and you have a lot of time, um, you might be watching something else, but you might want to still keep track of this alert. Boom, alert on eyes. Sorry, condition, stockwhispers.net, ultimate buy signal, once per chart, create, boom. Now you automatically have 2 alerts. One that's going to give you an alert when a buy shows up on the 5-minute chart, and also an alert when it shows up on the 15-minute chart. And now you can go back and be watching anything else that you'll get that notification, and you don't really need to be looking at the chart. Okay, so I think this concludes kind of the tips and tricks for that. This is something very simple that you know anyone can use. Just adding the moving averages. I cover like time frame. It doesn't matter what time frame, whichever one you're comfortable with. You'll get entries on all time frames. Um, any questions? Hello?
No, I have none.
Any questions?
Yes,
No.
just one question, Paulo. In this case, in 15 minutes charge, where this rule, the candle rule, applies, what you explained before.
Do we
In
have
this
any
case,
questions?
I
hello.
think someone was asking a question, Matos.
Any comments about the entries and the tips?
Yes. Are you hearing me, Paul?
I could hear you, but I don't know. I don't know if he can't hear you.
Oh,
I
sorry.
don't think so.
Hello?
Hello.
Yeah, sorry.
I was in mute
Oh,
for some reason.
my speakers were off. So
Don't worry. No, I was just asking you.
okay, hold on.
Relative to
Let me
the
confirm something. Did you guys hear everything, or was I silent?
yes,
You heard everything?
yeah.
Okay, great. Or else I'd have to record this again. All right, go for it.
Okay, I just want to ask you, relative to the 15 minutes alert. In this case, the 15 minutes chart.
Okay.
Can you put it? Okay, so you have the buy signal there.
Mm-hmm.
Okay, relative to the candles, the example you gave before applies here. The example that this is a buy signal, looking only for the candles.
Looking only to the candles. Is this a buy signal? I mean,
Yes.
yes, you got a buy signal here. I mean, this is your buy signal. This is where you get in.
Okay. Yeah, but taking in consideration what you said relative to the candles before, I would like to try to see this information. Let's say looking only to the candles. How can we see that this is a buy signal? You have a
Without the
tool.
indicator?
Yes, without indicator.
Okay, gotcha. Okay, perfect. So it opened right here. It opened inside this candle. It did not make a new low, and it closed outside of it. Right?
Okay. Yeah.
It opened right here, inside this candle.
Yes.
Candle opened inside this one, and it did not make a new low,
Okay.
and it closed outside of it.
Okay. Understood. Okay. Okay. Okay.
That's
Thank you.
for the
Thank you.
ultimate strategy. I mean, for the other ones, it's different. Um, sorry. Okay. Now let's get going. Any more questions? Now that I can hear you.
Hi, Mythos.
Hey.
Thanks for this. You've spoken quite a bit about the aggressive strategy. Haven't really spoken about conservative. When would you use that?
So it's also a personal preference. Like all strategies, they they give different signals, right? You can do this. You can come here, and you can turn them all on if you want. They all each one kind of kind of abides by different rules. So this one has certain rules to happen, this one and this one and this one. So the conservative is a strategy that's going to get you into the trade um, later, a little later than everyone else. So if you're looking for an aggressive, very aggressive strategy, you're going to get in here. If you're looking for a conservative entry, you're going to be getting in, 57% after the price move. Um, but you're going to get in here, it's going to be a reliable signal, but your profit potential is going to be less. Okay. I can't get into the details of the strategy, but let's just say that it's a little bit more reliable than all of the others, but with reliability comes less risk, and with less risk comes less profit, or less profit potential. Um, Also, another thing is when you're trading the conservative entry, because it takes longer to get you into the trade, you may get some situations like this one where you're getting into the trade, at the end of the upward movement, right? So you watch this one, you don't take it. You watch this one, you don't take it, and you decide to take this one, and you're like, oh damn, why didn't this one work? Um, you got in, at a resistance. First, you got in at a resistance, um, at the end of an already big upward movement. Um, Now, if the question is like, why would a more conservative entry, you really don't want to use it on smaller time frames. But if your question is like, why would I choose the conservative entry over, any other? It's just personal preference. Actually, these were names that we gave the strategies just to have something. Um, the way this should be used is, you this, right, or this. This is what you have, and you have to just decide what time frame you want to trade on. So let's say the daily, and then you have to go, you know, to each strategy and just kind of flick through them and see which one, gives you a better, a better reading on the chart. So based on the very aggressive, does this look good to you? Okay. The very aggressive is going to get you into the trade earlier, but it's going to be more sensitive. So it's going to be more risky, right? So because it's more sensitive, you see, you get a sell here, you get a sell there, you get a sell there. If you're using the aggressive, you see, it's going to get you into the trade a little bit later, and it's looking a little bit more reliable. But again, here in this consolidation period, it gets you a little sell here. You would have made a little bit, then it gets you in the buy. You would have made a little bit, but it's kind of in this chop area. Eventually, you would have got this buy, and you might have even lost this move, um, depending if you took this entry. Uh, Conservative, this is what it is. Would have got you in here, 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 here. Conservative is looking actually pretty good. Last time you got a sell, it dropped substantially. Now you got a sell here. Um, what you're expecting is probably this to drop substantially. Um, it's up to you, you know. Or, you could, or, okay, we're looking at this. This is a perfect scenario from 1999 till now. Sorry, 2019 till now. Um, But if you looked back at 2018, you got to sell here. It wouldn't have worked out too well. Then you got buys. This was a pretty bullish time, for Apple as well. A sell, you're probably trading against the trend anyway. So, it's personal preference. It's really, this is what you have to do is, go to the indicator and flip through, the strategies and see which one is working, right? And now you're like, okay, I just got a sell signal here. Do I short here or do I wait for my next, alert? You can set up an alert here, right? So condition, stock whispers, conservative buy or conservative sell, whatever you're trying to do. Once per bar closed, expiration time open-ended so that it doesn't, then you create it, boom. Next time a sell signal is going to show up on Apple on the daily chart, you'll be notified and you can look at it then. I don't want people to think that uh, the conservative or the the aggressive or very aggressive is related to the security of whatever it is you're trying to do. They are all risky. Okay, there's the conservative. It's not, the conservative is not going to um, make it more safe. The aggressive, is not going to make it more safe. That's why, we go with stop losses. So the only thing that's going to make this safe is you getting a buy signal and you putting a stop loss right below the candle before it. Right? Boom. 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 So this is the only thing that's going to make your trade safer is if you use stop losses. If on the conservative, since April 2020, you would have not lost one trade. And should you have lost it, your stop loss would have been there to stop you. So, um, the stop loss strategy is the same for all of the strategies. I think that it should be in the candle right before the signal. It's also up to you to kind of decide. Not a recommendation. Again, this is all for educational purposes, but just use stop losses. And if you're stopped out, don't worry about it. Just get back into the game, find the next signal, take it, put your stop loss, and go move forward. Any other questions, comments?
Hi, Mattis. Just a quick question. You were talking about stop losses. If you are inside a pattern and you have a buy signal, you should put the stop loss in the candle before or outside the pattern.
I'm sorry, say that again.
If you have a buy signal and it's inside a pendant, for example, you should put the stop loss on the candle before or outside the pattern.
That's completely up to you.
Okay.
Seeing is that these strategies don't identify pennants and stuff like that. The only thing they identify is entry points. Um, if you find one inside of a pennant, so okay, this one looks like it. Sorry. So you have one here, right? Kind of like a little pullback there. This is still inside of it, so all of these, they're already kind of outside. So let's talk about this one. Should you have gotten into this one, your stop loss would have been here, right? Which at the same time would have coincided with, underneath the flag. So it would have matched. I would use, whatever you're comfortable with, this stop loss or below the flag, or whatever you're trying to do. It doesn't.
Okay,
I mean,
thanks.
I I like using this strategy. Stop loss right below the candle right before it. This starts moving up. I'm right here. I'll just kind of move my stop loss to my entry point, and then go from there. But if you're trading also this, you can also do this. So if you're trading this, right, you get this buy signal here. Okay, now automatically you're on alert already. You can also wait for price to break up above to enter the trade. You can wait for price to break out of the channel, to enter the trade. You can enter it here and put your stop loss down there. The difference is you're going to get in at a higher price, with a little bit more certainty than, if you got in here. So here you're going to get in with, a 4% stop loss. Here you're going to have a 6% stop loss. So your stop loss is just going to be further away, which in turn is going to be, increasing your risk.
Okay, thanks.
But if you look, one important thing, that this is a game of odds, so probabilities. If you go and you look back 2 years, right, 2, 3 years, go analyze all of these signals. Go break them down, literally. Take the trade. Go here. Short position, stop loss there, right? Short position, stop loss there. This is a pretend trade, but actually do this on your chart to see what happens. Right? This is the best thing that you can do to see if what you're doing works. Okay, so in the last, okay, let's, okay, so let's look at all these. I literally took all these trades. Let's see what happens, right? 1, 2, 3, 4, 5, 6, 7. So in the last 7 trades, I lost one. I lost this one. Right? I was stopped out on this one, and then this one. Okay, there's probably a trend change here going on, and actually it fell. But and then if I keep going, you'll see. But in 1, 2, 3, 4, 5, 6, 7, 8. In 8 signals, I lost, 2, right? So that's 25%. So that's a 75% accuracy rate from August 2018 to May, 2019. And if I keep going, by the looks of things, it will probably stay within that, within that, within that average, just by looking at it. But go back and do this on every strategy, and find the strategy that you're comfortable with. Find the strategy that works for you and for your style. Maybe this is something that doesn't work for you. Maybe you want something a lot more active, right? Flip to the very aggressive. Sorry, flip to the, very aggressive if you want something more active. But then don't complain that okay, you do get in early, but okay, I miss a little bit more. You know, if you're okay with that, which I personally am, I'm okay with getting in early, right? So let's do this conservative. So just to show you here, I'm okay with getting in here, right? And putting my stop loss there and writing this up 20%, or getting in here, writing this up, okay, 8%. I'm okay with this, and I'm okay with losing more plays because when I do win, okay, it's going to give me better returns. But that's me. I don't go all in here. I don't go all in here. I play it small. So I'm okay with small losses and having more small losses, and but when I win big. Some other person, he might not be okay with more losses. He might want a little bit more accuracy. So he comes out to the conservative and he says, "Okay, I'm okay with less signals and getting in later. I'm okay with less signals and getting in later, and not maybe not making as much, um but I really don't have time to be around this thing every day, nor do I want to. um right. And I'm okay with conservative, right? I don't want to get in down here. I don't want to get in down here and make these 28%. I want to get in right here where I know I'm going to be late, right? But, you know, I want to only make 5 or 10%. So this profitability here, for me to make this trade, right, to make this 28%, I'm going to be risking more because I know for a fact that the very aggressive strategy is has a 50-50 ratio. So I back tested this and I looked and I counted the signals, and it's only right half the time. But when it is right, okay, it's right big, but it's only right half the time. If you're okay with that, that's a good strategy for you. If you're not okay with that, then maybe that's not a good strategy for you. You got to find, use one of the others. Um, Another way that I like to use these indicators is for the long term. You know, long term trading. Look here, a weekly chart, right? A weekly a weekly chart of Apple on or even hell, a monthly chart of Apple. A buy down here in 2013, a buy here in 2016, a couple buys here in 2019. If you're having trouble with long term, you want to know when to invest long term, just go to the very aggressive strategy, put it on a monthly chart, and boom, boom, boom. Here's your entries. Okay, where do I get into Apple? When do I get into Apple for my long-term portfolio? It's easy. When you see a buy signal, you know. Again, this is not financial advice. Past results do not predict the future, and this is all for educational purposes. But you see what I mean? You can use this for any kind of entry you want. Of course, you need to go back and just make the time frame higher. Weekly. You're not going to be trading the 1 and 5 minute anymore. You're going to be trading the weekly. But you're like, here's Chewy. You may want to be careful here. You just got a sell signal on the weekly. Oh, but the buy signals on the weekly seem to work out well. Okay, when do I get into Chewy for the long term? When you see a buy signal. Are you going to get less buy signals? Of course. Last one was in 2020 sometime, and now you just have to wait. Um, okay, I put in, you know, 20,000 here, 20,000 there. That's my strategy. I'm a long-term investor. That's perfect. Okay, I get bored by doing this. I don't want to do this. Okay, no, so what should I do? Okay, I'm gonna put it on a daily chart, right? And I'm going to put it on a conservative, right? And I'm going to instead of buying, you know, 20,000 on every buy signal, I'm going to buy, $50 on every buy signal. And I'm going to go boom, 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 and I'm going to buy them all. Okay, so when do I get into Chewy? When do I get into Chewy for my long term? Okay, that's easy. You wait for the buy signal on the daily. It's not going to happen every day. You're going to get a bunch of signals throughout the year, but you're instead of putting down 20,000 at each buy signal, you're only putting in 50, $50 at each buy signal. Then the guy comes to me and he says, "Oh, you're a good Dodge investor. What's your strategy on Dodge?" I mean, my strategy on Dodge is easy. Every time this thing drops 30%, I buy. Right? That's my strategy. I don't even use the indicator for this, but you know, every time this thing drops 30%, I buy. So, 30% drop, I bought some there, I bought some there. Now I'm waiting to buy some more should this level come and test again. So here's why I'm trying to buy. But just for the hell of it, let's now play with, this would have given me 4 entries, right? So 4 entries on Dodge. Now just for the hell of it, let's play with the indicator. So, okay, so we know for a fact that, buy strategy, conservative, let's see, ultimate. Yeah, ultimate's looking kind of choppy. Conservative, aggressive, very aggressive, conservative. Okay, conservative looks good. Guys, give me just a second here. So conservative looks good. So, I'm not going to put, $20,000 here, but I'm going to put in $50 there, $50 there, $50 there. Ride this up, $50, $50, $50, $50. Okay. So my average is probably somewhere around here, right? I don't know where the low is going to be, but if I stick to the trend, if I stick to the trend, four-hour chart, I would have bought $50 here, $50 there. Just find a time frame that you want to trade on, and just ride with it. Conservative entries, a little bit here, a little bit there, and just wait. So, oh, actually, we got this buy signal here. That one was beautiful. So just 50, 50, 50. Your average is probably somewhere around here, probably down here actually, if you took that one. So you'll be good long term. This is also a very good indicator for long term. Um, okay, guys. So I have about 20 more minutes um, to go through this. So questions, more questions. Any more questions?
No.
Does anyone have any more questions about the indicator or the strategies or how to use them?
Not for now, thanks.
No problem. Did everyone understand how you can use the moving averages uh to trade using the using the direction, I guess. So if you use the if you use any of these strategies, okay. So what you're looking for is this scenario here. Okay. Again, this is the 1 minute, doesn't really reflect anything, but boom. Close to the 50. Look, buy. Close to the 50. Buy. Close to the 50. Buy. You know, here it's okay to take these trades, but the whatever it is you're trading has to be on a very strong uptrend for it to hold the 20-day for a long period of time. Okay. So Bitcoin, all right? Look, this one worked a little bit. It was closer to here. This one worked, but reversed, and it came back to the 50. Went up, down, came back to the 50, right? We're looking here, and we're finding a little bit of resistance in this area. Of course, this is the 1 minute. Our condition is still met ever since here. We could have bought here. There's a little bit of resistance here. Trend is still looking good. So we should still be taking the buy signals, or we can wait for this to break up and take any buy signals once it's up above this resistance, right? So ideally, you want to enter here, here. You know, it looks like it might be making a little bit of a triangle here. So you would expect this to either, break up or break down at this point. So might be careful here, taking any kind of entry. Cool. So any questions? Any more questions? Any doubts? Anything what to look for? So we went over SPY, we went over eyes. Let's check out Uber just for the hell of it. So Uber popped up, same scenario, This here is what you're looking for. From this moment on, this crossover. Buy, 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 buy. This was already getting pretty extended. Time for a bigger pullback. It pulled back. This crossed over, like a little red flag here. Crossed over again. Okay, time to start finding the buy entries again. So it popped up, pulled back. Well, buy entry. You could have bought here, 55. Okay. See what else we got. Anything from my watch list here that it's gone up a lot. Ethereum's popping up. Okay, so Ethereum, look at the moving averages. Boom. Right? 1 minute. We have the 20 over the 50 over the 100. It just crossed. Look at this. Buy. Buy it here. Buy it here. Buy it here. Stop. Stop loss. Stop loss. Stop loss. It's the same thing, guys, over and over. Dish. This is a pretty big move. Dish. Boom. Here I'm testing the 200. Apple. Apple when it popped up. Okay. Short and put side. Very quickly here. Sell. Stop loss. Sell. Stop loss. Sell. Stop loss. Does it sting? Sell. Stop loss. So on the short side, when we're playing the short side of the trade, you have a lot more tendency for price to hold below the 20-day because it's a faster move down than it is a move up. So it's safer to take the sell signals when below the 20-day on when you're on the short side than it is when you're on the upside, because the upside is a much slower move. So you have more tendency for it to test the 50, and when it's down, you have more tendency for it to stay under the 20. See, it's under the 20, it pulls back to the 50, and then it, boom, drops, below the 20 again. Cool. So, any questions? So we can wrap this up.
No, I just gotta. I never knew about the shorts because it's just confusing. You like one as a red signal and you say buy, but I see you buy the stock short and expecting it to go down and then resell it, right?
I'm sorry, can you ask that again?
Like the only thing that was confusing, it was just when the red signal for sell, you would say to buy, but I understand that you're buying the short to short the stock in order to go down and then resell it back, right?
So I said when it's a red signal to.
No, when you see the sell signal, you say to go short, right? That means just short the stock.
Well, yes. So going short means when you're getting like a put, or
Okay, I get it now.
or you're shorting the stock.
Okay,
So this is where you want to get a call, right?
right.
Because we're in an uptrend. This is where you want to get, a put because we're in a downtrend.
Okay,
Um, Also regarding the trends, you want to look on the daily to see what the main trend is. So on the daily, it's on an uptrend. Then you maybe want to go to the 5-minute chart and wait for it to be on an uptrend before you start taking buys, or you will be trading against the trend.
okay. Thank you.
No problem. Any more questions?
Does it make sense to combine the ultimate strategy with a very aggressive one?
I think they're both very quick. They're very quick.
Okay.
They're very fast strategies. So the very aggressive and the ultimate, and they're just going to give you a lot more signals. Um, I would say to look at both and see which one you're comfortable with.
Mm-hmm.
Like both of them, then by all means use both of them, but change the colors so that you know which one is the ultimate and which one is the very aggressive. And
Thanks.
this is completely up to you. If you're comfortable using both, or if you're comfortable using the conservative and the ultimate, or the aggressive and conservative, that's completely up to you. You can use it however you want. I just say to, paper trade it with these signals to to see how it worked out well based on your strategy in the past.
Yeah. Yeah. Okay.
Okay. Any more questions? Questions, anyone? Okay, if there's no more questions, I'm gonna wrap this up. Hold on just 1 second. Okay. Okay, so thank you guys for being here. I'm gonna wrap this up and appreciate you all being here. I hope, using the indicator or not using the indicator, I hope this has, opened up your eyes a little bit to should you be buying or selling, and how to identify the trend. Um, and hope it's helped you guys along the way. The indicator is 10-day free trial, so you're free to use it for 10 days. Um, no charge. So, or you can just kind of go and have your own strategy. Um, okay, hope to see you guys in the chat room. Hope to see you guys on Whispers. Thanks for sticking with us. Times have been tough the last couple of weeks, but we're here to try to keep you guys out of trouble in the bad times and get advantage of the good times. Okay, so
All right. Thank you very much.
no problem. Bye bye.
Thank you for your time. Bye bye.
Thank you very much. Bye bye.
Thank you.